Hi there, and thanks for stopping by the Equity Trust Virtual Classroom. My name is John Bowens, and in this segment, we're going to talk about the difference between a traditional IRA and a Roth IRA. And when I talk about the difference between a traditional IRA and Roth IRA, I am speaking specifically about a self-directed IRA. Now, keep in mind, folks, don't be confused. Self-directed is merely an industry term. It indicates to you that you have the ability to self-direct into the assets that you deem best fit for your portfolio. In other words, you get to take full control. And a self-directed IRA with a custodian like Equity Trust can enable you to go beyond just traditional stocks, bonds, and mutual funds. You can invest in a wide array of alternative assets such as real estate, gold and silver, cryptocurrency, private placement investments, oil and gas partnerships, and a wide array of other alternative investments. So let's get started in the difference between a traditional IRA and a Roth IRA from a tax perspective. So with a traditional IRA, this is referred to as a tax-deferred or tax-deductible IRA. When you put money into the account as a contribution, or maybe you had a 401k or 403b or other employer-sponsored plan that you're making contributions to over the years, and you're getting tax deductions for those contributions. Those monies then get rolled into the traditional IRA. In fact, we have a whole nother training all on rollovers and transfers and the methods of funding the traditional and Roth IRA. With a traditional IRA, when you put money in, you get a deduction. It grows tax deferred. So in each incremental year, as you generate income from your investments, as long as you're following all the rules and all the procedures, the gains are tax exempt. It's not until you begin withdrawing funds from the traditional IRA that you will be subject to taxation. Now, when does that occur? Well, the qualified retirement age in the United States is 59 and a half. So at 59 and a half or older, when you begin taking money from the traditional IRA, the amount that you withdraw is added to your tax return and you pay taxes accordingly. So for example, let's say you grow a traditional IRA to $1 million. And at the age of 59 and a half, you take a $100,000 distribution. That $100,000, because you didn't pay taxes on it yet, that $100,000 is going to be added to your tax return, and then you're going to be paying taxes accordingly. So let's make the assumption that you're at a 20% effective tax rate environment. So 20% of $100,000 is $20,000. So you take your $100,000 withdrawal, you keep $80,000, and then $20,000 has to be paid in the form of taxes. The analogy we use in the industry is with retirement plans, you either pay taxes on the seed or you pay taxes on the crop. With a traditional IRA, when you put money in, again, you got a deduction, so you didn't pay taxes on the seed. Eventually, you have to pay taxes on the crop. Now, what happens if you take money out of the account, not for investment purposes, but for personal purposes? Because keep in mind, if you're investing in gold and silver, for example, or real estate or private placements, when you take the money to make that investment, that's an investment. There's no tax consequences or penalties, so as long as you're following all of the rules. But if you take money out for personal purposes prior to 59 and a half, there is a 10% premature withdrawal penalty. And that works the same you'll see for a Roth IRA. So let's now move on to the Roth IRA. In contrast to the traditional IRA, a Roth IRA is funded with after-tax dollars. So you get the taxes out of the way in the seed, and then you don't have to pay taxes on the crop. After the age of 59 and a half, providing that the account has seasoned for 5 years, you got to keep in mind that you have to have had a Roth IRA. It could be any Roth IRA with any financial institution, but you've had to have the Roth IRA for 5 years and attain the age of 59 and a half before you can start taking tax and penalty-free withdrawals. If you take money out premature, just like the traditional IRA, there's a 10% penalty. So with the Roth IRA, we refer to this as a tax-free IRA because the growth is tax-free and your withdrawals are tax-free. Not just for you in your lifetime, but you'll also learn about inherited Roth IRAs where you could potentially leave your Roth IRA to a child or grandchild and they can enjoy some of the same tax-free benefits that you got a chance to enjoy in your lifetime. So think of it this way. Going back to our example of $1 million and taking $100,000 out at 60 years old, we take $100,000 out of our Roth IRA at 60 years old, even if we're at a, let's say, 20% effective tax rate environment. We don't have to pay $20,000 in the form of taxes because we already paid taxes on the seed. That $100,000 is all retained by us 100% tax-free. So the Roth IRA has some unique tax advantages, but let me not say that the Roth IRA is far superior to the traditional IRA, because as you can see with the traditional IRA, you get tax deductions for the money going in. So there can still be some advantages to the traditional IRA for some investors. We would always encourage folks to talk to their CPA or tax accountant regarding traditional IRA versus Roth IRA. And you'll also learn in some other training videos that we have here is you can initiate what's called a Roth conversion. So if you like the idea of a Roth IRA, but you don't have a Roth IRA today, maybe all you have is traditional IRA funds, you could actually convert funds from your traditional to your Roth, pay the taxes on the seed so you don't have to pay it on the proverbial crop. Again, we have additional training on that. So let's take a look at this from a compounding interest perspective, from a time value money perspective, really to paint the picture for you on the difference between a taxable environment, a traditional IRA environment, and a Roth IRA environment. So what I've done in this financial hypothetical here is I have assumed that I'm going to make a $6,000 contribution for 25 years, and I'm going to apply a rate of return of 12% in each of those 25 years. I'm going to apply a tax rate of 30% during my years of contributions, and then a 20% tax rate during my year of distribution, which will all occur 25 years from now. So again, $6,000 going in every single year for 25 years, earning 12% per year. In a taxable environment, you'll see here, I have $601,000 saved. In a traditional IRA environment, you see here, I have $894,000 saved. So if I compare my taxable environment to my traditional IRA environment, I'm saving $300,000 in taxes. Now, why is that? Because in a taxable environment, as I earn every year, as I generate income from my investments every year, I'm applying in this hypothetical scenario a 30% tax rate. Now, that's not to say that's the same tax rate for everybody, but using this example, plugging in 30%, I have $601,000 saved in my taxable environment versus $894,000 in my traditional IRA environment. So again, I saved $300,000 in taxes. Applying these same numbers to a Roth IRA, you see here $1.117 million saved. So if I compare my Roth IRA to my traditional IRA, I'm saving just over $200,000. If I compare my Roth IRA to my taxable environment, you see there over $500,000 in taxes saved. So this is a very basic time value money example to demonstrate the difference between a taxable environment, a traditional IRA environment, and a Roth IRA environment. Keep in mind, the Roth IRA, being left to a child or grandchild, can continue to grow tax-free. There are some rules around inheritance with both the traditional and Roth IRA. Under the Secure Act, those inherited IRAs can only live on for 10 years. In most circumstances, there are some exceptions to that rule, but by and large, for 10 years. With a Roth IRA, however, keep in mind, that is a tax-free account left to your children or grandchildren, and their withdrawals, even prior to the age of 59 and a half, are 100% tax-free. I hope you enjoyed this video on the difference between a traditional IRA and Roth IRA. We have additional training coming up on how to fund a traditional or Roth IRA through a rollover from an employer-sponsored plan like a 401k, a transfer from another IRA, a contribution out of pocket, or, like I mentioned before, converting funds from a traditional IRA to a Roth IRA. Look forward to seeing you again in the virtual workshop here at Equity Trust Company. Again, I'm John Bowens. Keep leveraging compounding interest in the absence of taxation.